People are leaving the country in record numbers.
The exodus of New Zealand citizens leaving the country hits the highest level in 13 years.
Tens of thousands of Kiwis packed their bags and jetted off to live overseas in 2024.
1.5% of an entire country's population left in just 1 year. You heard it right. In 2024, New Zealand lost 75,000 citizens, people fleeing what was once called paradise. But why?
The year is 2025. While the world's eyes are fixed on economic powerhouses like the US and China, New Zealand, home to just 5 million people, a country often praised for its pristine landscapes and quality of life, is sitting on an economic time bomb that few seem to notice. New Zealand's household debt-to-income ratio has skyrocketed to 160% since 2005 and stayed above 160% since. That's higher than other developed countries such as the United States, France, Germany, and Italy. That means the average Kiwi owes far more than they earn, and it's getting worse. On the surface, things look fine. New Zealand has a $257 billion economy in 2024, GDP per capita around $48,000, comparable to other developed countries like France, Germany, and Italy, and global praise for its pandemic response. But dig a little deeper and the cracks start to show. After GDP rebounded by 5.6% in 2021, it contracted by 0.5% in 2024. Inflation surged to a 3-decade high of 7.2% in 2022, driven primarily by soaring housing costs. The unemployment rate, once a beacon of hope at 3.3% in 2022, has climbed back to its pandemic peak of 5.1% in March 2025. And the most chilling stat? That mass exodus since 2019. 150,000 people left the country in just 2 years, most headed to Australia and the UK, chasing wages, housing, and opportunity that New Zealand can no longer offer. These numbers paint a picture of an economy under severe stress. So what's driving this economic unraveling? Why are New Zealanders abandoning their own country in record numbers? And how did a nation once ranked among the world's most livable suddenly find itself on the edge of a demographic and financial cliff? Behind New Zealand's economic crisis lies a less visible but far more dangerous threat, a productivity trap that's quietly strangling the country's future. As Nobel Prize-winning economist Paul Krugman famously put it, in the short term, productivity isn't everything, but in the long run, it's almost everything. And here's the bad news. New Zealand's productivity growth has been crawling at just 0.6% per year over the past decade, which is well below the OECD average of 1.9%. This might sound like a small difference, but compound it over time and it's huge. If New Zealand had matched the OECD average since 2000, its GDP per capita today would be about 20% higher. So what's holding the country back? New Zealand's geographic isolation and tiny market size may automatically drag down GDP per capita by up to 10%. Entering the New Zealand market often proves unprofitable for foreign firms and held back by stringent regulations on foreign ownership of key national assets as compared to other developed countries. Foreign direct investment remains relatively low. Meanwhile, domestic companies face high barriers to scaling internationally. The result? Industries dominated by a handful of big players with little incentive to innovate, compete, or drive prices down. Compounding these issues is the country's chronic underinvestment in research and development. Historically, New Zealand's R&D spending has been well below 1.5% of its GDP, with its highest level achieved in 2024 at a mere 1.54%. This pales in comparison to other developed countries like Israel, 6.3%, South Korea, 5.2%, and the United States, 3.5%, and even falls short of the OECD average of 2.7%. Even other small economies like Finland and Denmark significantly outspend New Zealand in this crucial area. The consequences of this underinvestment are far-reaching. For New Zealand, it has meant fewer technological breakthroughs, stagnated industrial growth, and an inability to develop competitive high-value sectors that could help diversify the economy. Smaller local businesses, lacking access to both foreign and domestic capital, often struggle to invest in productivity-enhancing technologies, further contributing to the persistently low productivity growth across the economy. This productivity gap creates a vicious cycle. Lower productivity growth means slower wage growth, which in turn contributes to issues like housing affordability and income inequality.
It also makes New Zealand less attractive for foreign investment and more vulnerable to external economic shocks. The issue is made even worse by the fact that New Zealand depends almost entirely on China as a primary trading partner, which we will explore in a bit in this video.
Now, let's look at the pillars of New Zealand's economy and their vulnerabilities. The country's economy is precariously balanced on a few key industries, primarily agriculture and tourism. This lack of diversification is like putting all your kiwi eggs in one basket. Recent events have shown just how risky that can be. Agriculture accounts for about 6% of GDP. Dairy and meat accounted for a staggering 34% of exports. New Zealand isn't just dabbling in dairy, it's the world's largest exporter of dairy products. But this agricultural superpower status is a double-edged sword. First up, price volatility. In 2015, dairy prices took a nosedive, plummeting by over 50%. The result? Billions wiped off New Zealand's export earnings faster than you can say, spilt milk. And let's talk about that clean, green image New Zealand loves to project. Well, it's getting a bit muddy. According to government data, nearly half of the country's rivers are now deemed unsafe for swimming. And a separate study found that 60% of freshwater sources contain elevated nitrate levels, raising serious concerns about both environmental sustainability and public health. What is the cause? Well, you guessed it right, intensive dairy farming. The Selwyn River, once a symbol of pristine beauty, is now a case study in environmental collapse. Toxic algal blooms fed by nitrate runoff turn its waters bright green before they flow into Lake Ellesmere, one of the most polluted lakes in New Zealand. It's a striking reminder, when economic expansion overrides environmental limits, the consequences can be severe.
Agriculture also accounts for about half of New Zealand's greenhouse gas emissions. Imagine trying to reduce your carbon footprint when your biggest export industry is essentially a methane factory on 4 legs. Tourism, the other pillar of New Zealand's economy, is equally vulnerable. Pre-pandemic, it contributed about 5.8% directly to GDP. And when you factor in indirect effects, it's closer to 10%. Tourism also employed 8.4% of the workforce. But when the pandemic hit, international tourism spending plummeted by 91.5% in the year to March 2021. Similarly, international education, once the country's 4th largest export, worth about $4 billion annually, dropped to just under $100 million in 2021. Tourist numbers have since rebounded, though at a slow pace to about 80% of pre-pandemic levels. The government's recent decision to triple the visitor tax from $35 to 100 New Zealand dollars has sparked concerns among industry leaders, with fears it could further delay the recovery in visitor numbers to beyond 2026. But perhaps the biggest risk of all is the concentration of New Zealand's export markets. Its heavy reliance on a single trading partner, China. Let's put this in perspective. Before 2008, China wasn't even in New Zealand's top 5 export destinations. However, this changed when New Zealand became the first developed economy to sign a free trade agreement with China in 2008. Fast forward to 2024, New Zealand exports more to China than it does to Australia, the United States, and Japan put together.
Guess what is the main export? The primary sector, particularly the agricultural sector, accounts for a significant proportion of the country's exports to its top 5 trading partners. And for China, over 70%. This demand is driven by China's own challenges feeding itself. It has 18% of the world's population and just 9% of the world's arable land. For example, China also does not have enough dairy cows to supply its growing demand for milk. This concentration of trade brings with it significant risks. Any hiccup in the Chinese economy, any shift in its policies or consumer preferences, could send shockwaves through New Zealand's export sector. Take, for example, the case of A2 milk, one of New Zealand's dairy success stories. When China cracked down on informal imports of infant formula in 2019, A2's stock price plummeted. But it's not just economic risks. As geopolitical tensions rise, particularly between China and Western countries, New Zealand finds itself in an increasingly uncomfortable position. On one hand, it relies heavily on China for trade. On the other, there are more differences emerging in this relationship as China continues to adopt a more assertive posture. These differences range from human rights abuses against Uyghurs in Xinjiang, China's crackdown on democracy advocates in Hong Kong, or its treatment of neighbors in the South China Sea. This balancing act was put to the test in 2020, when New Zealand was labeled a weak link for not joining its Five Eyes intelligence alliance with the US, UK, Canada, and Australia, in condemning China on issues such as the Hong Kong protests. It's a dilemma that encapsulates the risks of New Zealand's trade concentration. How do you maintain your values when your economy is so dependent on a single partner?
The fear that demand could drop off is not unfounded. Australia has felt the wrath of China in the past couple of years. Australia's Foreign Affairs Minister, Marise Payne, called for a probe into the origins of the COVID-19 virus. In the following weeks, China started enacting a litany of official and unofficial trade sanctions. So, what is New Zealand doing with China now? Well, in short, still trying to be friends. Talks between the two countries' leaders include deepening trade and investment ties and peace and security in the Pacific with the growing China presence. New Zealand's economy, heavily reliant on a few key sectors, is particularly vulnerable to external shocks. The country's current account deficit, which stood at negative 6.1% of GDP in 2024, remains among the highest in developed economies. This means New Zealand consistently spends more on imports and servicing overseas obligations than it earns through exports and returns on overseas assets. The shortfall is financed by foreign borrowing, creating a precarious situation. In 2023 alone, interest payments to overseas investors were roughly 3 times higher than the interest received from overseas, highlighting the burden of this external debt. Another critical vulnerability is the New Zealand dollar's volatility. As one of the most traded currencies globally, it's susceptible to rapid fluctuations. For instance, during the COVID-19 crisis in March 2020, the Kiwi nosedived by over 10% in just a few days. Such currency instability can quickly translate into higher costs for businesses and consumers in this import-dependent economy. These external vulnerabilities expose New Zealand to the risk of sudden stops in capital flows. If international investors lose confidence in the country's economy, perhaps due to a global downturn or a shift in risk appetites, the consequences could be severe. The country could face sharp currency depreciation, higher borrowing costs, and a painful economic adjustment, potentially triggering a crisis that could ripple through the entire economy. New Zealand's housing market has become a ticking time bomb, threatening to detonate the entire economy. Over the past decade, house prices have soared by more than 60%, far outpacing wage growth and pushing the Kiwi dream of homeownership out of reach for many. The scale of this crisis is staggering. The median house price to median income ratio stands at about 9 as of 2024, and depending on which cities you live in, it can range between 7 to 11. In simpler terms, it would take 9 years of the average Kiwi's entire income to buy a typical house, and that's assuming they didn't spend a single dollar on anything else. To put a global perspective to this, New Zealand house prices rose by about 130% between 2008 and 2021, exceeding increases in the United States, United Kingdom, Australia, Canada, and Ireland. This housing bubble is creating a mountain of debt. Remember that shocking 160% household debt to income ratio we mentioned earlier? Well, about 90% of that is mortgage debt. This may not be a problem in the short term, until some of these highly leveraged homeowners lose their jobs due to the internal vulnerabilities and external economic shocks, or an increase in interest rates to control inflation. The roots of this crisis can be traced back to the Employment Contracts Act of 1991, which replaced collective bargaining with individual contracts. When workers lost bargaining power against employers, wages stagnated, and in turn made property investment an attractive alternative, especially for speculators. The government's decision not to tax profits from property sales, combined with relaxed zoning rules, turned housing into a lucrative commodity. Investors poured money into real estate, driving prices up as they competed for properties. As prices climbed, so did construction costs, creating a vicious cycle. Cash-strapped local councils couldn't keep up with infrastructure needs, leading to urban sprawl and even higher land prices. The consequences are severe. In 2024, 28% of renters and 15% of homeowners were spending more than 40% of their disposable income on housing costs. 55% of renters and 34% of homeowners felt their income was barely sufficient. Not enough and just enough to meet everyday needs after housing payments. This isn't just about property, it's a perfect storm of economic factors. Unaffordable housing drives talent overseas, weakens productivity, and strains infrastructure.
With banks having about 60% of their lending tied up in residential mortgages, any significant downturn in the housing market could trigger a crisis that extends far beyond the property sector, threatening the foundations of New Zealand's economy. New Zealand has long been the poster child for fiscal prudence, with net government debt at a modest 19% of GDP in 2019. But then came COVID-19, and suddenly it ballooned to 45% of GDP in just 2024. COVID policies more than doubled government debt, largely due to wage subsidies and lockdown measures. The center-right National Party government, elected in 2023, has initiated widespread public sector cuts and reduced spending to control debt. When Finance Minister Nicola Willis hands down her second budget in May 2025, it was against the backdrop of a wildly unpredictable but lower growth global economic environment. And against that backdrop, she has issued a stark warning that all debt needs to be repaid in the future, but that the future is now. But there have been some negative side effects. Public healthcare, for example, saw funding cuts that stretched hospitals to their limits, increasing wait times and reducing available staff in critical areas. In education, capital investment for school infrastructure projects was delayed or canceled, leaving many schools operating under substandard conditions. Transport and infrastructure were also hit, with delays in road maintenance and a scaling back of planned projects under the National Land Transport Fund. These austerity measures, while aimed at fiscal responsibility, risk exacerbating the country's economic challenges. It's like trying to save money by skipping meals. You might reduce your expenses in the short term, but you're setting yourself up for health problems down the line. New Zealand's story is far from over. The question remains, can New Zealand reinvent its paradise? Or will it become a cautionary tale of economic complacency? What do you think?